Merry Christmas and welcome to the first in the series of 12 tips of Christmas videos. What we're doing is we are releasing a tip for trading the stock market every day throughout the 12 days of Christmas. In that stock in there is a lot of years of experience trading the stock market, tips that we've learned along the way. You can't learn that stuff in textbooks, but we're sharing at least one tip every day throughout Christmas. So let's go and pick one at random. We'll be doing this for 12 days throughout Christmas. Let's hope we pick a good one, because this is the first one. You're going to judge us on this one, we know that. Alright, what have we got? Right, the tip number 4, staggering fills. Basically, let's say you want to buy gold at $1,100 per ounce. Now, what you do is you look at your chart and you realise there's support at $1,100 per ounce. So what you would do is you might put, a lot of traders stagger their entries. So they might buy at 11.05, 11.04, 11.03, all the way down to $1,100 per ounce. So basically, this highlights another point that support lines are areas of support. Just above the support line is an area of support. It's not an exact science, you're not guaranteed to go down to the support line. But for this one, what we're going to need to do is we're going to need to highlight and illustrate this on our whiteboard.
So we want to buy gold on a support line at $1,100 per ounce. We start putting our orders in at 11.05, 11.03, 11.02, 01 and on the support line. We have a stop loss at 10.88 just in case the support line doesn't hold and the market goes down. Now let's say the market is at 10.11, it drops to 05 and 03, which we are able to buy at them prices, and then the market goes higher. So we bought the low of the day and we made a profit, but only on a small amount of our target position because 3 of our orders didn't get hit today. So we only bought a small amount of gold. So let's look into the possibility that actually instead of that scenario, something slightly different happened. The market went down to the support line, we bought and then it went below our stop loss and we got stopped out, which means we sold at a loss what we bought previously. Now we are fully invested. We have a big position on gold because all 5 of our buy orders got hit and we ended up getting stopped out. So to combat this, because if you use this strategy, you're likely to get stopped out with all of your positions and make profits on small positions. What we would do is at 11.05, put all of your buy orders in at 11.05. So if the market drops to 11.05, you are fully invested in gold.
Welcome back. So as you would have seen by that short clip, what can happen is when you stagger your entries, okay, there is an advantage to staggering entries because if the market comes down and you buy at 11.05, 11.04, 11.03, it doesn't go any lower and goes up, you've bought the low of the day, which isn't a bad thing. The problem becomes when you only get filled on a couple of your orders, and this happens so much at a time. The market won't actually go down all the way to a support line. It hovers above it, there's a lot of buying activity and it goes up. This is why traders do buy just above a support line. The problem is when you stagger, there is a very good chance most of the time that you're only going to get filled on a couple of your buy orders and then the market's going to go up. You'll make a profit, but it'll only be a profit on some of your position. Whereas on losing days, where the support line doesn't hold and you actually get your stop loss hit, you're going to buy, you're going to buy, you're going to buy, you're going to buy, and you're going to buy. All of your orders are now filled. You're now fully positioned and the market drops and hits your stop loss. So you've made a big loss. And to be honest with you, when you make a big loss like that and you're only making small profits on your winning days, that could mess you up for, a week or two. And just because you're using a staggering technique, what we suggest, and certainly what we use, there's 2 ways of doing it. If you're starting to buy at 11.05, buy with at least 75% of what you want to buy. So say you want to buy 40 contracts in the S&P, buy 30 at 11.05 and stagger the remaining 25% if you really do want to stagger. Personally, we like to buy 100%. We don't mess about. We will sacrifice a few points. We don't need to buy the low of the day every time to make money. So we buy at 11.05, 100%. So if we want to buy 40 contracts, we buy 40 contracts. at 11.05, the market comes down, maybe goes to 11.03 and then goes upwards. We are filled on all of our orders, we make a big profit and we've done our job. We didn't buy the low of the day, we don't need to buy the low of the day. So do consider that. If you are someone who staggers their orders, do consider the fact that you really are only going to get filled most of the time on those times when you're on a losing day.